Here is something that should stop you cold before you touch a single order tonight. At precisely 6 Eastern Time, when futures markets reopen on this Sunday evening, April 19th, 2026, the silver market is going to do something that most retail investors have never personally witnessed, and that the handful who have witnessed it before never quite managed to forget. It is going to gap. Not drift, not ease lower, gap. Violently, mechanically, and with a precision that reveals just how thoroughly the architecture of this market has been engineered to serve interests that are not yours. Silver closed Friday at roughly $81 per ounce, near a one-month high as investors briefly dared to believe in something. They dared to believe the ceasefire would hold. They dared to believe the Strait of Hormuz, the narrow choke point through which approximately 1/5 of the world's oil and natural gas normally passes, might actually reopen for commercial traffic. Iran's own foreign minister had declared it completely open on Friday. President Trump welcomed the announcement on social media with what can only be described as characteristic enthusiasm. Oil prices plunged more than 10% in a matter of hours. The S&P 500 hit its third consecutive record high. The mood, however briefly, was genuinely euphoric. It aged poorly, with a cruelty that financial markets seem specifically designed to inflict. Within 24 hours, less than 24 hours, the Islamic Revolutionary Guard Corps reversed the entire announcement. Iran's Supreme National Security Council issued a formal statement saying it would prevent any conditional or limited reopening of the strait. Iranian gunboats fired on 2 India-flagged tankers attempting to transit the waterway on Saturday. The IRGC issued a warning so stark it deserved to be read carefully. Any vessel approaching the Strait of Hormuz would be considered cooperation with the enemy and would be targeted accordingly. What had been, on Friday afternoon, a moment of fragile hope became, by Saturday morning, a complete military closure, again. The second such closure in the span of this conflict, which has now entered its 8th week since it began on February 28th. And here you are now, Sunday evening, watching the clock move towards 6 p.m. Eastern, wondering what is about to happen to your silver position, wondering whether the number you are going to see when those futures tick to life represents a temporary disruption or something far more consequential and far more deliberate. The answer to that question requires understanding not just the geopolitics, dramatic and genuinely dangerous as they are, but the specific financial machinery that sits beneath the silver market and that has been caught, documented, prosecuted, and fined, and that continued operating after every one of those consequences as though they were merely a line item on a quarterly expense report. The ceasefire between the United States and Iran is set to expire on Wednesday, 3 days from today. Iran and the U.S. have made progress in negotiations, but remain a long way from a deal, according to Iran's chief negotiator. There is no confirmed meeting scheduled for tomorrow. Pakistani mediators are reportedly attempting to arrange a second round of negotiations in Islamabad early next week. But as of this moment, this Sunday evening, no date has been formally announced by either Washington or Tehran. The ceasefire that has kept active military hostilities on pause is burning down like a fuse, and the two parties most responsible for extinguishing it cannot agree on what table to sit at, or whose preconditions must be met before they sit down. The standoff in the Strait threatens to plunge the region back into a war that has already killed at least 3,000 people in Iran, more than 2,290 in Lebanon, 23 in Israel, and more than a dozen in Gulf Arab states. Those are not abstract numbers. They are the human cost of a conflict that the silver market, the paper silver market, the COMEX silver market, is now using as the backdrop for an operation that has nothing to do with human cost and everything to do with institutional balance sheets. Roughly 20% of the world's oil and natural gas normally passes through the strait, and the disruptions have caused crude prices to jump sharply, with analysts warning they could reach $100 per barrel or higher if disruptions persist. The options market has already assigned a 44% probability to $100 oil this month. That is not a fringe forecast from a Permabull newsletter. That is the collective judgment of professional traders pricing risk in real time. $100 oil is not merely an energy statistic. It is an inflationary event that simultaneously raises the cost of transportation, manufacturing, agriculture, and the production of every physical good that moves through any supply chain anywhere on Earth. And silver, which is simultaneously an industrial metal with production costs sensitive to energy prices, a monetary metal that historically surges when inflation accelerates, and a financial instrument whose paper price can be mechanically separated from physical reality, silver sits directly at the intersection of every one of those forces tonight. The institutions that dominate COMEX silver trading understand this intersection with extraordinary clarity. They also understand something that most retail investors do not, that maximum fundamental uncertainty is precisely the condition under which certain operations are most profitably executed. And tonight, the uncertainty is as maximum as it gets. Before you read another word, if any of this is making you think differently about how these markets actually work, if something here is clicking into place that you have sensed but never been able to articulate, hit that subscribe button right now, because what comes next is the part they will never teach you in a standard finance course, and it is the part that determines whether you survive what is coming at 6 tonight or become one of the statistics that funds someone else's exit. To understand the mechanism that is about to operate on the silver market, you need to understand who actually controls it and what they have already demonstrably done with that control. The CME Group, the exchange on which COMEX silver futures are traded, counts among its largest shareholders Vanguard, BlackRock, and JP Chase. JP Chase is simultaneously one of the exchange's largest shareholders, its largest market maker for silver derivatives anywhere in the world, and one of the largest holders of physical silver in both registered and eligible COMEX vaults. This triple structural position, exchange owner, market maker, and physical metal holder, has no real parallel in any other significant financial market. And it is not a position that has been held innocently. In September 2020, the Department of Justice and the Commodity Futures Trading Commission fined JP Chase $920 million specifically for manipulating gold and silver markets over an 8-year period spanning from 2008 through 2016. The bank's traders were not merely fined, they were criminally convicted. The conduct involved placing massive orders, called spoofs, orders never intended to be executed, placed solely to create the false appearance of buying or selling pressure, moving the price in the desired direction before canceling the fake orders and executing the real trades at the artificially manufactured price levels. JP Morgan was not alone. Scotiabank, Deutsche Bank, HSBC, Bank of America, UBS, Goldman Sachs, and Morgan Stanley were all fined by regulators for substantially similar manipulation of precious metals markets. The total penalties paid by those 8 institutions for silver manipulation specifically exceeded $1.3 billion. $1.3 billion in fines for documented, criminally prosecuted silver market manipulation, paid, and then everyone went back to work. The events of the past several months have provided a recent and vivid illustration of how this system operates when it feels the pressure of a rising silver price. Silver remains nearly 15% lower since the conflict began on February 28th, even as the fundamental case for the metal, supply deficits, monetary inflation, industrial demand from solar and electronics, geopolitical instability, has never been stronger in modern memory. The Silver Institute and Metals Focus have warned of a 6th consecutive year of structural deficit, with 762 million troy ounces drawn from stocks since 2021, raising the risk of a liquidity squeeze. The paper price and the physical reality have been pulling apart. The Shanghai premium, the difference between what physical silver commands in China versus what the COMEX paper price says it is worth, has persisted at levels that signal genuine physical scarcity, even as the futures price has been repeatedly hammered lower. When the physical market and the paper market tell different stories for an extended period of time, one of them is eventually proven correct. The history of commodity markets suggests it is invariably the physical market that wins that argument. But the institutions that run the paper market have demonstrated, repeatedly and with documentation, that they can delay that reckoning long enough to extract enormous value from the investors caught in between. The mechanism that will operate tonight is not random. When futures markets open with the Strait of Hormuz militarily closed, the ceasefire expiring in 3 days, Iran having reversed its own reopening announcement within 24 hours, and gunboats having fired on 2 tankers transiting the waterway Saturday, the institutions that are short silver in size need the resulting panic to accomplish something very specific: forced liquidation of leveraged long positions at prices well below where those positions were established. Here is precisely how it works. When a market opens with a significant gap down, every stop-loss order placed anywhere between the Friday close and the new opening level executes simultaneously at the opening price, rather than at the price where the stop was originally set. An investor who believed they had protected themselves against a move below $78 finds themselves liquidated at whatever the opening price happens to be, $75, $72, perhaps lower, with no opportunity to react and no warning beyond the number that appears on their screen when the market opens. That simultaneous execution of thousands of stop orders creates an enormous cascade of selling pressure that feeds upon itself, because each forced liquidation drives the price slightly lower, triggering the next set of stops, forcing more liquidations, driving the price lower still. The algorithms that dominate COMEX trading in the opening minutes interpret this cascade as a momentum signal and add their own selling pressure on top of the forced liquidations, making the initial gap worse than the geopolitical news alone would justify. The banks holding large short positions benefit from every element of this cascade simultaneously. The gap eliminates equity in long positions. The cascade forces additional liquidations. The algorithms add momentum, and the resulting flood of forced selling provides the cover for the banks to cover their own short positions at the artificially depressed prices the cascade has created. When covering is complete, the cascade exhausts itself. The price stabilizes. The banks are now flat or long. The retail investors are now either liquidated or holding positions at a severe loss, and the cycle prepares to reset. This is not speculation about what might happen tonight. It is a description of a mechanism that has operated with mechanical regularity in every major silver sell-off of the past 15 years. The specific geopolitical trigger changes each time. The underlying mechanism has been identical each time. And the documented history of criminal prosecution in this specific market establishes beyond any reasonable argument that the participants who benefit from this mechanism have demonstrated both the motive and the willingness to actively engineer the conditions that allow it to run. There is a dimension to tonight's open that separates it from every previous engineered sell-off in the modern silver market, and it is a dimension that makes the longer-term implications genuinely different from what the short-term price action might suggest. Every previous episode of this mechanism, the 2011 COMEX intervention, the margin hikes of December 2025, the January crashes, was triggered by conditions that were in some sense containable and resolvable within a defined time frame. A margin hike can be walked back. A trading halt ends. The geopolitical trigger tonight is neither containable nor resolvable on any timeline that the market can currently see. With days until the ceasefire expires, Iran has said it received new proposals from the United States, and Pakistani mediators are working to arrange another round of direct negotiations in the coming days. That is the most optimistic available reading of the current diplomatic landscape. Mediators finalizing preparations, no formal announcement, no confirmed date. 3 days until a ceasefire expires between two nations that are simultaneously blockading each other's maritime access to the global economy. Trump said Iran had tried to get cute in taking back control of the Strait of Hormuz, a characterization that does not suggest a diplomatic framework approaching maturity. The Federal Reserve's financial condition adds an additional layer of complexity that sophisticated investors have not fully absorbed. The Federal Reserve reported an operating loss of $18.7 billion for 2025, its third consecutive annual loss, bringing the cumulative three-year total to more than $210 billion. These losses stem directly from the Fed paying more in interest to commercial banks and money market funds than it earns from its portfolio of treasury bonds and mortgage-backed securities purchased during the quantitative easing programs of the previous decade. A central bank losing money on its own operations while simultaneously confronting an oil-driven inflationary shock is a central bank that has been stripped of its normal policy flexibility at precisely the moment flexibility is most needed. If oil reaches $100 per barrel, which the options market now assigns a 44% probability, the Federal Reserve faces a genuine, impossible choice. Raise interest rates to fight the resulting inflation and deepen its own operating losses while threatening debt sustainability in an economy carrying record levels of both public and private debt. Or hold rates steady and allow inflation to accelerate, eroding the purchasing power of every dollar-denominated asset and further damaging the credibility of monetary policy itself. There is no third option on that menu, and the absence of a viable third option is precisely what makes the longer-term fundamental case for silver as genuine monetary protection, not merely as a commodity trade, so structurally compelling. Persistent and high inflation without a credible central bank response to contain it is the single most powerful fundamental driver of silver prices across all of recorded monetary history. Not because silver is speculative or exotic, but because the perception that monetary authorities cannot or will not protect purchasing power changes the behavior of millions of investors, corporations, and governments simultaneously, driving demand for hard assets in ways that compound upon themselves over time. Consumer sentiment is currently at an all-time low, with stagflation signals driving safe haven demand for physical precious metals. The Silver Institute and Metals Focus have flagged 6 consecutive years of structural deficit in the silver market, with hundreds of millions of troy ounces drawn from existing stocks since 2021. By year-end 2026, analysts project silver prices could reach levels significantly above current trading ranges as supply constraints and monetary pressures converge. Here is the tension that defines tonight's decision for every retail investor holding silver. The same forces that will eventually drive silver to levels that appear unimaginable from the vantage point of this Sunday evening are the exact forces that create the short-term conditions under which the institutional mechanism extracts maximum value from forced liquidations. Silver rises on long-term fundamentals. Leveraged longs pile in expecting those fundamentals to assert themselves immediately. The banks and the exchange intervene through margin increases, trading halts, gap opens, algorithm-amplified cascades to force liquidations at the worst possible moment. The price crashes, the longs are shaken out, and then the fundamental case eventually does assert itself at much lower entry prices that benefit the institutions that engineered the crash. The 1973 oil embargo, the last geopolitical crisis of comparable severity in its potential to reshape the global energy order, did not produce permanent precious metal declines. It eventually produced gains so extraordinary that they defined an entire generation's understanding of what monetary metals were capable of. The investors who were shaken out in the initial panic were precisely the ones who missed the subsequent extraordinary move. Whether 2026 repeats 1973 depends on factors that cannot be known tonight. Whether the ceasefire survives its Wednesday expiration, whether Pakistan successfully brokers a second round of negotiations, whether the United States proceeds with boarding Iranian-linked tankers in international waters, and whether Iran's response to such boarding constitutes the escalation that reshapes the conflict entirely. What can be said tonight, with the documentation that the public record now provides, is that the paper market and the physical market in silver have been structurally separated by institutional design, that the institutions which benefit from that separation have been criminally prosecuted for market manipulation in this specific market, and that the resolution of that separation, when it eventually arrives, will be violent, rapid, and enormously consequential for those who have maintained their exposure through the engineered volatility. Now leave your thoughts in the comments below. Tell me whether you are holding through tonight's open, reducing your position, or watching from the sidelines entirely. There is no judgment in this analysis for any of those choices, only the conviction that the choice deserves to be made with full knowledge of who is on the other side of your trade, what they have already done in this market, and what they are almost certainly doing right now as the clock moves towards 6 o'clock Eastern Time. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.